You feel relieved. One less bill to worry about. You open your banking app, look at your balance, subtract the payment in your head, and think, okay, I still have plenty of money for groceries, gas, and everything else I need this week. Then 3 days later, you walk into the grocery store, swipe your debit card, and suddenly your card gets declined. Confused, you open your banking app and discover your account is negative. Wait a minute, how is that possible? You already paid the electric bill. Here is where the trap begins. The money may have been authorized, but it may not have actually left your checking account yet. That gap between when you schedule or authorize a payment and when the money finally clears can create a dangerous illusion that you have more money available than you really do. Your bank balance can look healthy, while money you've already committed is still sitting there temporarily. So today, we're breaking down the 3-5-day bank trap, why it happens, and 3 simple strategies you can use to stop delayed payments from sabotaging your budget. We live in a world where messages arrive instantly. Money can be transferred between apps in seconds, and food can show up at your door in less than an hour. So naturally, we assume that when we click Pay Bill, the money immediately disappears from our account. But traditional electronic payments don't always work that way. Many bill payments move through the automated clearinghouse, or ACH, network, and the process can take time. You might submit a payment on Monday, but the merchant may not actually request or receive the funds immediately. Think about the timeline this way. Day 0. You hit submit and authorize the payment. Days 1 and 2. The transaction may be processing or pending while the payment information moves between institutions. Days 3 through 5. The money may finally settle and be reflected as a completed withdrawal. The exact timing varies by bank, merchant, payment method, weekends, holidays, and other factors, so don't assume every payment will take exactly 3 to 5 business days. Then when those bills finally clear, your balance takes the hit. The money wasn't really extra. It was already committed. So how do you protect yourself? First, stop treating your displayed balance as your spending limit. Look specifically at your available balance, and then account for pending payments and transactions that haven't fully cleared yet. Think of every bill you've authorized as money that's already gone even if your bank hasn't removed it yet. If your checking account shows $2,000 and you've scheduled $600 in upcoming bills, mentally treat that account like it has $1,400 available for discretionary spending. Better yet, track those upcoming payments somewhere outside your bank account so you can see the complete picture. This is where a budgeting system can make a huge difference. Instead of trying to remember which bills you've paid, which ones are pending, and which ones are coming next, you want one place that shows your actual cash flow. That's exactly the type of problem PaycheckPlanner.ai is designed to help you understand. Strategy number 2 is creating a bill buffer. This isn't permission to spend more. It's a shock absorber. The key is consistency. Treat that buffer as unavailable unless you're dealing with a genuine emergency. The third strategy can be useful for certain people, but it comes with a major warning. Strategically, use a credit card for routine bills only if you can reliably pay the statement balance in full. Instead of allowing a utility bill or subscription to pull cash directly from checking, you could place certain recurring expenses on a credit card that can reduce the risk created by ACH timing differences and give your cash flow more breathing room. But here's the critical part. This strategy is not about borrowing money you don't have. If you carry a credit card balance and start paying interest, the convenience of delaying the cash outflow can become much more expensive than the original problem. Instead, focus on your cash buffer and payment tracking. It's about when money enters your account and when money actually leaves it. That's cash flow. So let's recap the 3 ways to avoid the 3-5-day bank trap. Number 1, don't blindly trust the balance. You see, pay attention to your available balance and account for pending transactions. Number 3, if you use a credit card for recurring bills, do it strategically and only if you can pay the balance in full. Most importantly, remember this: when you authorize a payment, mentally consider that money already spent. Don't let a temporary delay convince you that you have extra cash. And if you want a better way to organize your paychecks, bills, expenses, and financial goals, Check out paycheckplanner.ai. It's built to help you see where your money's going and plan ahead instead of reacting after the damage is done. Your bank balance tells you what may be sitting in the account. Your budget should tell you what that money is actually available for. Remember, we're not just trying to survive from paycheck to paycheck. We're creating a system that gives every dollar a purpose because we are building real financial progress one step at a time. I'll see you in the next video.